Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Good afternoon, everyone. It is March 29th. The Bulls got game 60 on the board, and we're going to get into the weekly notebook review here in a minute. So we'll let folks kind of trickle in. George, it's a pleasure to see you. Arthur, Rod, Pokey. The list is endless. A lot of great friendly faces, so thank you for taking the time to join us. If you're new to the weekly notebook review, this is the time where we go through our notebook and review kind of the data that we put into it and the assessments we were making coming into the week and how things have changed or shifted here midweek and what that means for the setup going into the back half of this week, next month. And now we're into next quarter, back half of the year, et cetera, et cetera. April is crazy enough. First day of April from a trading perspective will be Monday, which is pretty crazy. Q2 is now upon us. Depending on how you measure yourself. Gavin had a really great commentary a few weeks ago about quarters, right? So he assesses himself from a football standpoint or basketball, what have you, and on a quarterly basis. Some might do it on a game by day, more of a basketball-oriented standpoint. How do you do today versus yesterday versus preparing for tomorrow and winning that championship at the end of the season. I think regardless of how you think about it, being disciplined and having your process and building that out is truly key to successful investing and to managing these markets. They can be very challenging, very choppy, as you kind of saw today. Again, depends on your time frame, time horizon, but certainly was not a day to do nothing out there. Volatility got down to pretty darn close to the low end of the risk range. Missed it by about 2 basis points. So that low end of the risk range on the VIX was 19.09 this morning and closes here today at 19.11. So that definitely is an interesting dynamic. Again, this is the kind of first time we got back into that sub 20, the low end of the chop bucket. That chop bucket, for those that aren't familiar, would be from the 19 to 29 range. And conversely, that means it's a choppy market, right? So investable bucket is 19 and below, and then the F bucket is north of 29. The top end of that risk range this morning has come in over the last few days, so it was just inside of 26 this morning, so it was a big lower high coming into the day, and I suspect that's going to kind of continue to signal that tomorrow as we get that updated range. But it certainly had been up near the top end of the chop bucket and poked its head over that 30 level as well. So just keep an eye on those. I think Keith certainly alluded to or put the question out there to Hedgeye Nation this morning in the top 3 things in regards to what did you do last time the Vixen was sub 25 or certainly had a 24 handle on it. And how did you act? How did you what positioning did you make? Were you bearish enough? Did you put on the positions you wish to? Did you have regret, et cetera, et cetera? I think for those that listened into the quarterly themes call, the Q2 quarterly themes, macro themes call this morning at 11. If you didn't get a chance to do that, that's for Macro Pro and institutional investors only. So that's a special event for them. I'll put a link up at the top in the nest here for those that may be interested in getting access to that. But regardless, I was certainly I think it was all over my feed. At least it was a lot of bear porn in there, but there's also a lot of bullish components as well. Bullish gold, bullish duration, adding kind of TLT, the longer end of the curve, markets and mayhem, and I and a few others talked about that on Tuesday's Wolf Financial call spaces session. So if you didn't get a chance to listen to that, there's a lot of great commentary there. I was at noon yesterday. So go take a look. A little bit different, certainly, than the notebook review in terms of subject matter, but we definitely reviewed, the longer end of the curve, duration, pricing in recession risk rising, with the 2-year, staying more in line with no cut Powell, right? So no Fed cuts on the horizon, at least in our view. That's what the risk range is also signaling, where it's narrowing. It's 64 basis points wide this morning, and yeah, so those are a couple of things that I just wanted to get out there for those listening in. If anybody wants to jump up and speak or share, happy to have some company up here. I don't need to be doing a bunch of monologues and discussion points, but I will certainly keep rolling as we get going here. So the other components, obviously, this morning and today, commodities is a big one. Again, with gold on one side, if you're long gold or precious metals, silver, platinum, those would be two long exposures we'd be having on the long side, and conversely on the short side. Copper is neutral at the moment, but it certainly would be kind of taking a look at shorting that on the short side. But a no-brainer there on the short side would be crude oil, and that was right at the pretty darn close to the top end of the risk range today as well. Where did that end up finishing up? CL 72.81, not quite the top of the range, but yeah, 74.27. Yeah, 74.27. So, but again, so another, if it sticks around here next day or two, that would be a big time lower high. So that'd be very bearish for crude. And I think that's certainly something that I'm keeping a keen eye on. Also watching that volatility component. So OVX, it has dripped a little bit lower here down into the low 40s, 43. But it's got a long way to go to get back into that kind of range-bound crude oil pricing, where it was really kind of between 70 and what was that, like 70 and 80 or 70 and 85. We were talking about that level for quite a while, 70 to kind of 80, 82, 71 to 82 range for about the last 3 months. So that level, or that kind of sustained band, was certainly with OVX kind of sub 40. So keep an eye on that. It is almost there, and I think that could be a really telling sign. I've said this many times on the Weekly Notebook Review, Beginner's Guide, across the board, wherever I speak, and I really have adapted it from Keith, because he's a great coach. Is volatility, when volatility leaves an asset or starts to get removed or kind of shrinks away, or volatility, however you want to bloody say that, capital gets attracted to it. So with VIX down to 19, OVX down at 43, GBZ down at 17.77, VIXen at 20, 23 and change, capital is drawn to those. Even the move was down a little bit too at 150 and a half. So again, capital gets drawn to those when volatility comes out of those assets. But then it becomes, okay, what is the setup? What does the future look? What is the quad setup in terms of the Hedgeye framework? And that recession risk rising is absolutely a critical piece here. I mean, I think you're about to get some Q1 earnings are kind of around the corner over the next 3 to 4 weeks, really, some of the big boys, and that's going to be a telling sign, where they stand. You had Lululemon report yesterday after market, obviously kind of surprised at the upside, really, I guess, but the inventories were building. So again, what is that going to mean for the consumer? What's the shape of the consumer in? Certainly the data that we're seeing, and I don't want to give too much away from the Q2 macro themes call, but that data is no bueno, as one might say. So in terms of not only the consumer and the increased need to leverage their kind of credit and credit cards in order to fund their life and lifestyle, but so again, these are all a lot of different data points out there that are kind of going negative. And the recession risk, again, I'm just going to keep saying that it's less about inflation at this point, although the Fed is obviously focused on that, but it's much more about the recession risk rising, and you can see that starting to get priced in the longer end of the curve. So so I'm going to just take a little break here. Again, Pokey, I see you out there. George, Syracuse, if you want to come up, it doesn't really matter who wants to come up. We can keep on rolling. I've got eyeball to talk about, lots of other stuff like China, but give me 1 second here. All right, so the other big theme here, and obviously is in the headline of this space is China. I think it's the big panda bear in the room, to use a little levity. So the or dragon, maybe we can call it the golden dragon. But the China, I mean, it's the quad one data certainly keeps rolling in. The local market, again, I'm not trying to just kind of reiterate what Keith said on the macro show this morning, but I think it is very, very critical, and it's the reason why he highlighted it. It was certainly something that was being highlighted in my notebook over the weekend, and the price action is confirming that. So again, really important to be speaking about this. Baba's got a 6-for-1 stock split, and you got the Shanghai, the local index, not acting exactly like kind of the U.S. listed in the Hang Seng, but at the same time, you're getting the quad one data that's rolling in, and we actually added some exposure to Taiwan today. So I think that's an interesting aspect in ETF Pro. So if you didn't see that, it should be in your inbox. ETF Pro and Investing Ideas. There are some changes that we made to those. But at the same time, the Hang Seng, I think it's really Hang Seng's kind of hovering right around the trend line. So, typically you'd want to see that trend line turn into support. It has not, it's been kind of flirted up here with it for the last, call it, week or so. And you really want to kind of see that trend line turn into support and have it recapture that bullish momentum. I think it'll be, SS&C still is bullish trend, and we would be kind of looking to add some exposure even on the KWeb side. So these are all things that are kind of interesting dichotomies that are happening out there from really the only country, and primarily it's, if you kind of want to know the why, it's because of the they're just coming out of basically COVID restrictions, et cetera, right? So they're in that kind of consumer growth phase, and it's not on the industrial side. And you're seeing that inside of the commodity prices. And again, that's why one of the reasons why we're kind of looking to see if copper confirms its sort of bearish trend, because the industrial side in China does not look like the consumer side of China. And Felix Wang, who I actually had the pleasure of sitting down with last week during our sector head spotlight discussion, I reiterated the same thing. He's seeing the data in terms of out of China and the luxury goods. It's absolutely accelerating. It was a big Q1 theme for him, and it's been absolutely spot on. You're seeing the travel component, the desire to travel. The COVID restrictions have been lifted. You don't even have to kind of quarantine or feel it. He was saying that it used to be a pain in order to come back to the country because you had to quarantine and do all this other stuff. Now it's all those restrictions have been lifted, so it's very easy for folks to travel in and out of China now. And I think you're seeing that data flow through. Todd Jordan has talked about it in terms of the data that's coming into Macau, et cetera, et cetera. But look for kind of some of these travel and leisure stocks or equities, to especially the ones that have Chinese factor exposure, to be to perhaps outperform anything else that we're seeing out there, certainly within the U.S. equity base. So I just want to touch base on China as well. And yeah, I think that was a pretty good rundown. Eyeball data, one of the call outs this morning that I circled or highlighted was XLB, GLD, and IEF. So again, if you have that data, if you wrote those down or kind of made note of those, those are kind of some of the ones that stuck out to me. So just wanted to kind of share that. I think the U.S. dollar correlations have been kind of interesting, and with this recent dollar weakness, you're seeing those correlations kind of strengthen a bit. Today, the dollar was stronger with the market even up. So an interesting component there. Perhaps that U.S. dollar correlation between SPX will continue to break down as it has over the last sort of 90 to 120 days. It's only at a negative 0.23 on a 15-day correlation standpoint right now versus negative 0.76 on a 120-day correlation. That gold correlation, though, is staying stronger or elevated. So it's still at a negative 0.87 on a 15-day, minus 0.8 on a 30-day. and minus 0.84 on a 90-day. So again, that had been kind of breaking down a little bit in about 2 weeks ago, I guess it was, but it's sort of that correlation that has picked up. So that's going to, the gold is really going to be more of a play on the real rates, and then but if that breakdown does continue to happen, then keep a keen eye on that, because a traditional quad four environment, you're going to see kind of dollar strength, gold strength, and longer duration bond strength as well. So just wanted to kind of call it that correlation. Interestingly enough, the commodity correlation on the U.S. dollar has turned positive. So it's at a plus 0.31 on a 15-day. Now, if you go back probably back to mid-February, so let's just see here, February 22nd, which was a random date in my notebook, that CRB correlation on a 15-day was minus 0.43 and minus 0.79 on a 30-day. So that's now looking at plus 0.31 and plus 0.43. So again, these are kind of things to notice. So that was about a month ago. Those correlations did look differently than they do today. So hopefully that is helpful. Pokey, how you doing, man? Could you tell I was getting?
I'm good.
Could you tell I was getting kind of like it was a little weirded out just talking to myself up here?
Yeah,
I mean, I can keep going. I have no problems with it, but I don't think that's what people really tune in for. They tune in for
no, it is.
yeah.
Objectively, it is, right. And for someone that hops up every now and then, it could be intimidating because there are such great and impressive people in this group. I'm looking down the list of people that that speak regularly, and it's intimidating. First, you don't want to sound like an idiot, and second, you want to bring something of value. You just don't want to come up and ramble like I'm doing right now. The thing
It's called
that stuck
filibustering.
out to
I'll take it. It's okay. No, but yeah, no,
yeah,
go
well,
ahead, Poke.
I live in DC, so I've been around that for a little while. The thing that really stuck out to me is the past couple of days is just really how market volume has kind of dropped off a cliff. Today is probably a little stronger. Today is much stronger than yesterday, but nothing really out there. And Mike Taylor had a tweet before that said a lot of the ETF volume was coming from rebalancing. I just think that if you look, the setup in volume looks really similar to going back to the end of February. And I think people are just kind of sitting on their hands, waiting to see what happens and for the next couple of days. But I think I haven't seen today's the macro deck yet, but I would imagine that starting in February, things are going to start to fall off the cliff relatively quickly. And I went back to, and I was rethinking about what Steiner talked about a couple of days ago on the call with the 2 months before what happened to the market the 2 months before the last time we had a debt crisis, and how the market fell apart. Like I think the number was 12%. And you can the things that I'm looking at, you can start to see how it's, the tide's starting to come out, and we might be seeing a real big regime change relatively quickly here.
Yeah, the volume component is a great call out. And even today, I was looking kind of at the end around 3:30, and it was pretty anemic. So not surprising that I missed that Taylor tweet, but not surprising that he's saying that a lot of it's coming from month end, quarter end rebalance, and that is a component here, right? And the liquidity, I think, Thousandaire FX has mentioned that on a couple times in the last couple of weeks on the notebook review, where basically this liquidity, it could be a bit of a double-edged sword, where a lot of folks are putting their money into the money market accounts or CDs or 6 months treasuries, 1 year treasuries, 2 year treasuries, and that money, that liquidity is getting kind of tied up in those assets. So is that a component or a small piece of what's transpiring from a liquidity standpoint? Perhaps, I don't know, right, Poke? But it's definitely, the volume was absolutely a key thing here, and I think one big reason why Coach was kind of going to the wood on a lot of the shorts that we like and that have worked over the last sort of 15 months, and that we see, or maybe new to the board, and that we see are kind of have a tough outlook here from moving forward. So I think a big example would be even XLK. That volume, I'm gonna I'm going to hold off on commenting XOK. I don't know if that volume that I'm seeing is actually accurate, but um, IBB was another one where that one was added on ETF Pro and inside RTA today. So definitely it was up pretty big, up 1.4%. I think is what I'm seeing on again kind of below average volume. So
Yeah,
definitely an interesting
XOK.
component.
Yeah, I track the volumes against the last 15 days, so for the trade average, and I have XLK at about 70, between 77 and 78%, depending on what happens in after hours,
Okay.
versus the last 15 days. So you're not seeing a ton of stuff, but
All right. Cool.
IWM half the volume today, 53% so far.
Wow. Okay.
There's some big disparities there. I'll be really interested. I wouldn't be surprised if Coach says tomorrow that the bear shit basket went up more than if he calls
Like
that out
six,
tomorrow.
yeah, 5% or whatever, 4%. Yeah, big
Yeah,
move.
and
Yeah,
nothing. It wasn't major today, but a couple of things I'm looking at, like some of the stuff that's just it went up a little bit more. Like it wasn't aggressive like GameStop a couple days ago, but I wouldn't be surprised if he mentions that in passing tomorrow.
yep. No, good call out. I mean, go down the list and even the Magma names plus N squared, so plus Netflix and Nvidia. I mean, pretty much everything just went to the top end of the range, 161. Yeah, I mean, just go down the board. It was pretty Tesla. Yeah, Meta pretty close. Google not quite there.
Yeah,
Netflix right there. Tesla not quite, and Nvidia. Not quite, but again, like just very interesting. So
yeah,
yeah,
and then
and on weaker volume, right? Like Nvidia's volume, to your point, I'm going to do the math here in a minute, but looks like about the same, maybe 80%, 85% of. I use average 10-day volume. Just FYI, I don't know. Is there a reason why you use 15? Just because, or do you find
I,
that's
I just no, I like to have everything kind of just within the trade duration. I think that
yeah,
for me it works better, but I rescale some Z scores for like 20 days, so
yeah.
just to give it a little more legs. But it's I forget what's Buddy was talking about it, right, when in one of the old interviews with Keith where he was saying why would you use volume statistics from 5 years ago for a stock? It's totally irrelevant. That you have to rescale everything for the time that you're in right now.
Exactly. Yeah, but no, it's good call out. Tim, Brian, welcome.
Robert, what's going on, man?
I'm good, man. How you doing?
Better than I deserve. Hey, let's do correlations, but let's talk sector correlations because they
All
have
right.
gone squirrel in this last move where you've got clearly some stuff way outperforming, some stuff way underperforming. Rotation
Yep.
out of tech back into tech, out of tech back into tech as we kind of run the nice edge here. And what you were calling out with the dollar correlation, I think is really interesting because as these correlations weakened, the whole thing just started kind of going sideways, and so we had to do these OODA loops into and out of these sectors um, to try and keep up here. And I'm really looking forward to the part of the game that's somewhere out there in front of us where all those correlations go back towards one.
Yeah, it's a great call out. Is there any particular sectors that other than tech that you're seeing or that you're kind of interested in at the moment more than
So
others?
So the
From
way that XLK and XLC are getting kind of bumped around,
yeah,
the lag that, of course, XLF is like, it would just getting whipsawed all around by, what Yellen said like 5 minutes ago and then retracted 10 minutes later. So it's hard.
yeah,
That's not tradable, I don't think, as far as, the ups and downs in that correlation.
agreed.
Um, but yeah, those as we see, like you just called out the magma names, as those things drive the XLK XLC behavior,
Yeah, yeah,
and then the small caps suck wind again. I think we're setting up, like Coach did at the end of the day today. You take advantage of the OODA loop, the opportunity that's presented here. As you guys have already called out on low volume to let's do it all again. Strike up the band. Let's go.
yeah.
Um,
And Tim, I think it's a good. Yeah, that's a good point. And all I will preface is that it really it depends, right? Like it depends on where you're coming from, right? So if you're kind of short and holding, which I wouldn't necessarily advise in the chop bucket, but let's just say that is what you're doing, right? And depending on where you're coming from, will impact kind of how aggressive or less aggressive you are in a setup, like in terms of like following Keith or not following Keith is what I'm trying to get at, right? So I think understanding this is where David Salem, who I can see in the office here and is listening in. He and I, talked about this a couple of weeks ago in terms of, building out your own process, right, and mimicking the mindset of a great investor versus mimicking the moves themselves. Now, I'm not saying that you can't mimic the moves and do it really, really well, but to your point, it's like building that process around you where you're looking at those correlations. You're looking at the volume from Pokey. You're looking at the eyeball tables. You're looking at a Poke. I think it was the eyeball, right, that you called out on the Z scores. Isn't that what you shared today? Wasn't that eyeball? I think the table. Doesn't matter. But my point is building that process around it, right, and building out your portfolio accordingly. And I mean, if you don't have a lot of short exposure on at the moment, I mean, this is this rally to recent new high. So I'll just pull up the cues, right? So that is we're right in line, right? Just the smidgen. There's such a smidgen above that February 2nd high. I mean, this is a hell of a setup, Tim, and I've been it's getting me excited. Timing is everything, though, and incrementally, because you got to be conscientious, because there are earnings on the horizon, and you never know how that might play out.
Yeah, we don't do the all or nothing thing. And if you do want to short and hold, and I do have a portion of a book that is short and is there for the long haul. But there's a big chunk, but that's what the minimum position is there for. And then we size that up as we come into this opportunity. I needed to have room to size this up so that I just didn't sit there from the lows, riding all the way up, getting my face ripped off. Now I'm a little bigger than I was at the beginning of the day or the beginning of the week even. And some of these things, and some of my longs are a little bit smaller incrementally than they were at the beginning of the week, and we'll see what happens. If it blasts higher, then we have the room to read and react and adjust. And if it goes lower, take profits.
Yep.
That's
absolutely.
For me, that was something that's changed over the last 3 or 4 months, is understanding when we're in this chop bucket, like Keith always says it, but you don't really, I didn't internalize enough that you've got to take that off the table. If you get to the low end of the range, take it back off the table and wait for it to set up again.
And sometimes it's not even going all the way to the low end of the range, right? Like it's you take it, if it's up, a percent or two, or even just again, I'd encourage everyone listening in to think about it more from a standard deviation move. If you're up like one standard deviation from or what have you, then take some off the table, right? Like make decisions around those probable outcomes, those probable ranges.
Well, that goes to process, right? Whether you're using 50% of the range as your target or 70% of the range as your target, you need to have a target and either have orders already placed or be ready to pull the trigger when things are right. Because if you just sit on it, could it go your way? Yeah, it could be great. Is it probably going to do that? And no, probably not.
Yep. And I've heard, or I've certainly, I think you and I spoke about this in Dallas when we met, but in the risk ranges, right, and reviewing things in and again, to your point, it's like you can do it if you want to look at it in thirds or halves or quarters, whatever it is, in eighths. I don't really give a shit what you look at it for, but have those, it's a time of your risk range, have those decision-making tools that process in place where if something's at, let's just say the top third of the risk range, then I'll just use GDX as an example. If GDX is in the top third of the risk range in a bullish trend, you'll make a decision there, right? Like lighten up 10 basis points. It doesn't have to be a full 25 or 50 or whatever it is, but lightening up a little bit and paying yourself, Tim, does give you that flexibility to make that decision. Conversely, when it's perhaps in the lower third of the risk range, and you can add back 5-10 basis points at a time, and just basically rinse and repeat where you're maintaining that core min to mid position sizing in something that's bullish trade and trend. So really good call out, Tim. Brian, welcome. I mean, let's not give away too much tonight, though, Brian.
What?
Right? We gotta entice him back for tomorrow, right? We can't just share everything on Weekly Notebook Review.
No.
We gotta save a little bit. You gotta tease him, right? Or is this the tease, Brian?
No,
You're gonna give him just enough to be like, come back for Hedgeye and Friends tomorrow
This
night?
is the standard, right? The kind of the standard here. No, tomorrow I'm excited. I got a lot of feedback this weekend from people, and I'm going to spend some time tomorrow getting my notes together. And I appreciate you work with me on the time. Next week's spring break, so I gotta get a haircut and all that kind of junk so I can get out of town.
No worries. Yeah. So for those that don't follow me closely enough or follow Brian not closely enough, he and I are going to have a Spaces tomorrow night at 7 is what we said, right?
Yes.
Brian?
7 Eastern.
So 7 p.m., 7 Eastern. It's going to be a Spaces session, Hedgeye and Friends, focused on muni bonds and fixed income and kind of how to think through that setup and incorporating, that decision-making process in adding kind of some fixed income into your own portfolio. And Brian's Brian you even got a shout out on the macro show.
I heard.
Yeah. So it's should be a really good combo. I full disclosure, I am going to be on the train, but it should be a-okay. So it'll work. We're going to make it work because we love Hedgeye Nation, right, Brian?
Oh yeah. And shout out to everyone who's reached out with questions. And I've been 3 weeks on the road meeting with issuers and getting deals together and stuff. I'm finally back for a week and did the macro themes deck today. There were a couple, there were like 3 or 4 slides that were good for some of our clients to see. No, it's all good. But did you see my tweet with my notes for the Nest?
I will go grab it. I saw it briefly, but let me go grab it, Brian.
Okay.
Because I know you were sharing you had some comments around a new deal, right? That was out there today.
No. That's different. That was just that was just me showing how I did the secondary market.
I'll go grab it though, Brian. I'll go grab it.
Yeah, it's just it's got a yellow background just from my Outlook notes. But so I'll just go ahead and kind of walk through. I know I've been on a lot of the feedback that I get. A lot of folks need to see it in order to kind of understand it, as opposed to just talking about it. So, all
right. So I just grabbed it. It's in the Nest. So for those that aren't familiar with Spaces Nest, just kind of go, pull down the screen a little bit on whatever you're listening, and you'll see Brian's tweet. You can click on it, and there's like a yellow image there, like an old school legal pad. My dad used to use one of those bad boys.
That's Outlook notes, by the way, Robert. Just so you know.
Yeah, it's.
Hi, I'm Keith McCullough, and I wanted to introduce you to my favorite product at Hedgeye, the Macro Show. Why is it my favorite product? Well, it's my show. I do that every morning. If you want to get ready for the market day, you want to contextualize all the data, you want to make good decisions, then this is what you should be watching. It's a repeatable process that you can deliberately study, measuring and mapping time series to time series of data. So it's not going headline to headline and getting whipped around. It's actually being so much more dispassionate about it and making good decisions that are data driven. So we'd love to have you on our team. Come join us.
Tune in weekdays at 9 a.m. Eastern and on demand anytime. Go to hedgeye.com/research to subscribe.
So,
cool beans.
I guess for my the muni bond anxiety meter, I know we got the Hedgeye Nation anxiety meter, but with everything going right with stocks, people are kind of not blowing up the fixed income side right now. Although we are seeing a little bit of a rally in some of the rates that I monitor, which is kind of it's indicative to me. But first off is SIFMA. So as a reminder, SIFMA is the 7-day weekly tax exempt rate. So there are a lot of municipal bonds that are out there, and there are also tender option bond programs that issue weekly rate paper. They're purchased by funds, they're purchased by money market accounts, and we track that rate. And so you can see that I pulled the low end of this year. So January 25th, we were at a 166, and we got all the way up to last week at a 435. And just real quick, if you're in one of the highest tax brackets, say you're 30% federal, so you take a 435 and you divide it by 1 minus tax brackets, 0.63. That's the equivalent of a 690, 6.9%. So you can see that SIFMA, from a tax adjusted perspective, it's gotten really, really high. And now we've reversed and we're starting this a different trend. But these leveraged funds that I've said that I'm not in and wouldn't recommend people to be in unless you fully understand the risks and are comfortable. What they do is they set up a TOB trust and they just leverage the rate. So they go out and they buy 4%, 5% coupon bonds, and they want the SIFMA rate to be in the sub twos and make it real generic. They just take that spread and pass it back to the investor in the core fund. But when it gets flipped upside down, then you have problems. And so all of last year, a lot of the bond selling was the unwinding of twos and threes coupons to get to higher coupons as the Fed was raising rates. And I think some people have been a little bit surprised how SIFMA has continued to kind of rise and then come back down and then rise and come back down. Every time we rise, we seem to get a little bit higher. It started in December. And so 435 kind of caught my eye. And just to give a pictorial, I put, what's good for tender option bond leverage and what's bad. So see the reversal. My guess is it will continue. And each time I've seen this reversal, we go into an equity sell-off mode, at least the last two cycles of this. So it'll be interesting to see. But if you ever wanted to look and see, examples of bonds, I post them every once in a while, but I put a notation that JMST is a JP Morgan fund that invests in these types of bonds. And so you can just go to the holdings and you can see the actual bonds and the CUSIPs and the names of, City of Charlotte types that issue these floating rate bonds. Number two is NAV for bonds. As I've said for a couple of years now, MMIN is a fund that I like only because it's insured paper, and the insurance companies by default pretty much stay in the essential service column. Most of the funds that you buy, when you go through the holdings, you'll find stuff that you wouldn't buy on your own. Sales tax driven toll roads, nursing homes, hospitals, just credits that I stay away from. But being insured, you sort of default back. And there is no essential service bond fund out there that I'm aware of. And I've scrubbed everything. But year to date, the fund is up 2.34%. Last month, 1.78 in the last 5 days, up 35 basis points. So, up for the year, rates are down. Prices are up, yields go down. And just tracking the NAV on that. Point three is the MMD. So the MMD is an interest rate scale in my world that we use to price bonds. So when we're bringing bonds into the primary market, we use that AAA scale as our benchmark. And so I just pull the 10-year rate because most of the time it's non-callable. We are seeing some 7-year calls, but generically we try to stay to a 10-year par call. So we started the year, January 3rd was the first trading day, at 264. And you can see, as I said a while ago in January, we have dismal supply. So a lot of things get gobbled up. So we rallied down to about a 219. And then through February, we began March 1st at a 259. And then we rallied here to today plus 30. So we're at a 229 on MMD. So it just gives you an idea of kind of the ups and downs of the tax exempt market from the MMD side. And then number four, I've mentioned this before, but I've actually taken a position in it. So BMN is a newish 2037 target term bond fund. It's not leveraged, and I put yet. So when you read the prospectus, it It has the ability to go leveraged, but they have not chosen to. So they started the fund at the end of last year. And as I said, SIFMA was higher at the end of last year. So they did not put the leverage on, which I like. It's at a time in which there were good credits at good rates to buy. And so you can see I put the distribution yield at the $25 price of a 450. And so the tax equivalent yield would be a 7.14%. And then I put the formula. So you can take the 4.5 and divide it by 1 minus your tax bracket, your federal tax bracket. So this has bonds all over the country. So if you're like me and you're in Kentucky and there's a 4.5% state income tax, you're not going to get that benefit. That's why I buy a lot of Kentucky munis and why a lot of people in various states, like if you live in New York and you have a high tax, or California, you have a high tax, buying California or New York bonds makes sense. But sometimes you want a fund, and to me, this was a pretty good fund to take a stab at. It has 81 positions. And the best information is actually not on BlackRock's website. It's on cefconnect.com. So I put the little link there. And then if you'd like to see the sister fund, BTT is pretty much the exact same thing. It has a different target term date, and it's running leveraged. And so I don't like BTT. I don't like the credits in it, and I don't like the fact that it's leveraged. But I like BMN right now because I went through the credits that they reported on 12/31 and was pleasantly surprised. And then I like the target term. I don't like an open-ended fund that doesn't ever have an end date. So when they put the leverage on, I'm going to guess it's going to be in the right economic environment, and then they'll increase their fee and they'll pass a portion of it back to the holder would be my guess. But so that's a fund that I've taken a position in. I know some other folks in Hedgeye world that we all talk, bond nerd math, have done some due diligence on, taken a position on it as well. Number 5 is CDs. So I've been posting a lot about CDs and the monthly pays in particular. There's a lot of folks out there that are scared and they've lost money, and they look at the monthly pay CD and they think about dividend income on equities and dripping that into risk on products. So same concept. I put up analysis before of buying monthly pay CDs and then getting your ETF Pro or whatever it may be that you have with Hedgeye for what may be bullish, and dripping the income into the risk on product. So you conserve your principles. You're not worried about that, but you're still taking some appropriate level of risk. But it's really changed, right? So I think we got to a 2-year, maybe a 3-year at 535. The best I could find today was 5% at a 1 year. And then the best long duration call protect that I could find was 475 for 4. So the CD market on Fidelity has drastically changed. There used to be over 200 offerings in a day. Today we went sub 100. So I don't know if it's the banks aren't issuing them since they can go to the Fed now a little bit more easily, or people are just buying them. But I don't know the reason, but I just know the results. So that's what I'm seeing on the CD side. And then money markets, I posted this earlier today. The default for me in my Fidelity account is the SPAXX fund, and it pays a 444. But they also have a premium class if you do a little research. And in like an IRA, the minimums are not too high, and you get about a 20 basis point bump. And my comment is no matter what platform you use, don't be lazy. Don't let your company put you in some core account that you're sitting at 70% cash and you're earning 200 basis points less than what a government money market account should pay. I'm not talking about a prime bank loan type money market account. I'm talking your safe AAA rated core government type account. Don't be lazy. If you got $25,000 sitting at JP Morgan earning 0 and you moved it over and put it in FZDXX, right? I put the math there. 25,000 times 463 is 1,157.50 a year. Divide that by, I went on DoorDash, $2.39. That's 484 McDonald's cheeseburgers, 40 free cheeseburgers a month. not including taxes. So, don't be lazy. Manage your money. Make sure you're getting every cent of interest that you can. Leave nothing on the table. This will end one day, right? If everything plays out as people think, we will not be seeing these money market rates at some point. So take advantage of it. Don't let it be squandered. Number 7 is my quad 4 reminder for those that don't like quad 4. I would fall into that camp. I like the calls in quad 1, 2, and 3. It's perfectly fine to stay away from equities and simply wait. Make sure you're investing your money and those money market accounts or whatever is appropriate for you, and simply wait. 8, doing nothing, not making a decision is actually making a decision. So don't think by not making a decision you're not making a decision. You are making a decision. Inaction is a decision. And then lastly is just a disclosure that nothing I talk about or discussing is financial advice. So that's kind of it, Robert, from my little world, my little corner. And tomorrow, looking more to get into strategies on how I invest in municipal bonds and what I do for my clients and how I look at things both directions.
Yeah, appreciate it, and love the way that you broke that down in terms of number of cheeseburgers.
Amen, brother.
That would equate. And secondly, that was a great rundown, man. So really looking forward to our session tomorrow. Again, just to reiterate, it's going to be at 7 p.m. here on Twitter Spaces, Hedgeye and Friends with Muni Guy. X2 even just DM'd me, Brian. He was like, DM me on the side. He's like, Brian should have his own spaces. Like, X2, I know we're doing it tomorrow night.
That's why you're here, Robert. You can coordinate that.
Yeah,
right?
that's right. It's like, yeah, we're coordinating. It's going to be a lot of fun. Should be great. So Brian, he and I have gone back and forth a little bit this week, kind of trying to pin down some of the subject matter and stuff like that. And so appreciate everyone's feedback and whatnot to Brian's tweet earlier this week. So looking forward to it. So again, 7 p.m. Weird thing with spaces that you can't send out multiple what's the word I'm looking for? Yeah, reminders, what have you. So you can only really do one at a time. So I couldn't do tomorrow's, but as soon as this one's done, I'll send that one out and I'll get that on the calendar for everybody. So look for that to come around. Tim, we haven't talked FX yet. And Tim, I know you trade FX. So why don't I throw the ball back to you for a little FX chat?
Sure. So I've got lots of questions and just a handful of answers on FX, but
That's
we
my
can go
favorite
around
kind of conversation.
we'll go around the horn real quick. I mean, I think everybody realizes, I think Keith says quite frequently that, there's one trade and it's all one thing. And he's usually talking about the dollar. If you get that right, you get everything else right. And that's certainly, we were talking about all the correlations kind of getting lost in the weeds. And one of those correlations, of course, is the equity dollar kind of correlation. We kind of bottomed back there at bear capitulation day at the beginning of February and rallied, and we're not back down there. We tapped the low end of the risk range just a few days ago, bounced off of it, and you saw Keith, kind of moving his position around as he sized up as we tapped the bottom end and lightened up as we got back toward the middle. But one of the things that's really interesting to me is when we look at the euro pair, we have 15-day highs in that risk range and 6 days of higher lows. Still bearish trend. Still just kind of riding the top end of the range as we crank up. And I think if you have seen some of Hedgeye's stuff in the past where we're on the macro presentation this morning or on the call, or really anybody that's actually pulling data out of Europe, we know that the outlook for Europe's not great, right? The retail sales numbers are not good. Their industrial numbers are not good. They continue to hike. They gave us a 50 basis point hike just a few weeks ago in the Eurozone. And the euro seemed to like that. And then, our friend Jay Powell only gave us a quarter. And the euro seemed to like that too. So, I'm looking for a spot to get. I'm already short the euro, but I'm not max. I'm looking for a spot to play that back down into the middle of the range as we kind of wait for the dollar to really kind of perk its head up and do what it does in Quad 4 and be the safe haven currency. I thought it was interesting that some of the commodity linked currencies are showing such strength. The Canadian dollar has been on a tear from almost the low end of the range 2 days ago, 3 days ago, it looks like, 4 days ago. So kind of like last Friday, almost pinged the bottom end of Monday's range and has catapulted up to the top end of the range. And that's really interesting with the Hedgeye view on commodities in the near term, heading into this Quad 4 event, to have such near term strength in that currency pair. Maybe an opportunity there. I wish Chris Moyer was on. We could make fun of the performance of the pound relative to the euro and get him going. But again, the pound is not as strong as the euro in my view, but it has ridden to the top end of the range. I think Keith said on the show this morning, I think it broke trend. It went neutral. I don't have that down on my notebook though.
It went neutral yesterday.
Yesterday. Oh yeah, here it is.
Yep.
Yeah, and then the last one that we track really close is the yen, right? And the yen has kind of gone neutral, gone bearish, gone neutral. And that one is with the implications for the carry trade, and what we know they've done with yield curve control. And Mike Taylor's talked about that quite a bit. You can have a strong currency or have yield curve control, and you eventually have to choose. So to watch that play out in real time has been really, really interesting. I haven't been playing euro for about 2 months. Not euro. I mean yen. Just because I didn't feel like I had a good read on, what that central banker was going to do, especially with the change of the guard over there. So that's Tim's list of observations, and I'm really looking for a spot to short the euro. If somebody has an idea on, why we should or why we shouldn't. I mean, it's bearish trend, top end of the range. Has bad macro catalysts inbound, and we all think Quad 4 is coming. So. Look for other people to chime in here and give answers instead of just more questions.
Yeah, so I'd encourage anybody out there who trades FX or is intimate with it. I see X2 up there. I don't know if he has. I know I just not made fun of you, but aired your DM. But I thought it was interesting today, Tim, that Coach went. I always pay attention when he certainly. Well, I pay attention all the time, but especially around currencies. And so he went to the wood on the Canadian dollar, both in RTA and ETF Pro. And so that to me was a signal kind of inside the signal. Whereas last week he went to and shorted the euro, which I also really enjoyed playing. So I thought that was an interesting dynamic there, where clearly, I think the signal on the Canadian dollar is a weaker signal, or in our case, like stronger from the short side. So a weaker Canadian dollar signal. And this is, to your point, you just summarized a lot of what has transpired in the last kind of week plus in terms of a kind of going from, one end of the risk range, the probable range, right, from the low end to the top end. And in conjunction with the move in commodities and energy related type exposure, or specifically energy related exposure. So I think that read through that one I'm much more comfortable with on the short side. I think euro here is an interesting one, especially So we just kind of failed at a new 1 month high, right, in terms of where we closed yesterday and today, but you're right at the top end there, and the top end of the risk range is signaling a new 1 month high in terms of the Euro USD range. So I'm very conscientious of that. When that starts to play into, or when I sort of see that on the board, I get not that I get less interested, but I don't get as big. I don't go as aggressive on the short side. I think I'm explaining that appropriately. So really here on the euro, what I'd be looking to see is a fail here at a lower high. So this is what I'd be looking to do. Again, it kind of goes into, how how you play the game, really, right? If you're trying to front run kind of the signal a little bit, you would be getting, anticipating and kind of maybe be adding a bit more aggressively here, with while also being on a bit of a tight leash, right? It's because if it does pick up momentum, it could go against you. But at the same time, on the flip side of that, the low end of the risk range down at one spot. 5.9 actually, sorry, my number didn't get updated, so 5.9. That is also so that was not only a higher low today, but also above both, where the 15-day price was and the 1 month, and above the 3 months. So again, that kind of like narrowing risk range volatility is kind of coming out. From a narrative standpoint, Tim, I would say that Europe and certainly the pound, or England, the UK, they were later to the game in terms of raising rates, and therefore it would appear that the FX market is sort of pricing that in right now, right? So I actually had the pleasure of speaking with Chris Moyer yesterday, aka Thousand Air FX, and I am not stealing, but because I'm giving him credit. But that was the commentary that he made, Tim. So although he couldn't make it today, it's his wife's birthday, so he's enjoying that time, as well as watching the girl Arsenal team, or the ladies Arsenal versus the Bayern Munich game as well. But that was kind of one of his commentaries, Tim, and it makes perfect sense. So again, it doesn't really matter why. I think we're much more focused on the signal, but that signal isn't quite as it looks a lot different on a week over week basis. Let me just put it that way.
Yeah, that's great. Thanks, Robert.
Yeah. Versus the Canadian dollar, and again, if you go back. What was last Wednesday? Was it the 24th? It was the 22nd. Here's a good example where, and I've talked about this a couple times the last few weeks. But if you go, this is where in the risk range, looking at day over day and week over week, the low end on the euro was 1.052 on the risk range, and today it's 1.059. The top end of that range was 1.081 on the euro last week on Wednesday, and today it's basically a penny higher at 1.091. So again, not only you're looking at higher lows, higher highs day over day, but on a week over week basis, those are relatively large moves within FX land. So that's a big tell versus, again, the Canadian dollar. Obviously, given this price move, you're going to see the higher lows and higher highs happen here, but they're higher. It's kind of like a higher high, higher low to a lower high, right? So, overall, we're coming on the 3 month basis. We were up at call it 70, just north of 75 cents, and we're just under 74 here. So this is where I think there's a big difference versus the euro, which put in kind of a 3 month high at just under $1.10. And now kind of flirting with $1.09. So just different setups here would be my 2 cents in the Canadian dollar. Just commodity related spaces or commodity related currencies are looking weaker. Even like the Aussie dollar, the USD, same kind of price action. That actually looks better to me than Canadian dollar, but nobody really gives a shit what I think. So I shouldn't say that. Let's stick with the Canadian dollar.
I do, Robert.
That's what Keith signaled on. I appreciate that, Brian. But Coach signaled on Canada, and we get that risk range every day. It's a lot easier to track. So we'll stick with the Canadian dollar. But it'll be interesting. I mean, I think 2022 was definitely the dollar was kind of was what you need to be long up until basically September, right, or October timeframe, and it was a big So it was a big winner. Dollar strength can absolutely still exist in the quad four environment, but all I'll say is that we are battling a rates environment that we have not experienced in quite some time, going back probably almost 30, 40, going back to the 80s. So this is every quad, every cycle is different. So just because it worked last year doesn't mean it's going to work again this year. Doesn't mean it's going to be shit or anything, right? And that you don't want exposure to the dollar. But to your point, Tim, or I think it's Pokey about the chop bucket, the FX vol is up at 10.65 as of this morning. So that's elevated too. So these currencies are getting choppier as well. And just for those that that might not be aware, FX Vol sub 9 is more investable bucket for kind of global currencies. So typically you would have you would decrease your exposure to US dollar in that environment, and north of 9 you want to be increasing your exposure. It's more kind of like the F bucket and the flight to safety. But Tim, that JPY is a older school, flight to safety, right? So again, with banks blowing up and what have you, it could be very much why you're seeing JPY strength here, or the yen strength, in terms of a flight to safety trade, which really means risk off across the market, which really means fade the fucking 2% move in tech today, right? To bring it full circle.
So Robert,
yeah.
On the risk off, so that would align with SIFMA going down, right? But talk to me about triple Q. So I did a post today. It was up 17.52% year to date, on pace to go plus 75.4% for the year. Doesn't seem like a sustainable path to me. But can you talk about what you're seeing in terms of higher highs, lower lows when you're tracking the risk range on triple Q? Because I am actually shorted.
Yeah. So you're talking your book, is what you're saying?
No, I'm asking about my book.
So yeah, it's an interesting one. I think the move from 17, the 17 and a half, I think it's hard. I saw your tweet there. I would say it's hard to extrapolate, although I understand what you're doing because it's pure math, obviously. But I would say it's tricky to extrapolate that, obviously, like one quarter across the year, and especially from where we came from in terms of like the end of 2022, it's still currently the 3-month low is right around. It's actually going to fall off tomorrow. It's Wednesday, December 28th, but that closing low is 260.10. Just to remind everybody where we came from 3 months ago. So that closing price was 260.10. We're now closed in at 312.72. So I think that's a big thing, right, Brian? Is we had a full cycle shift lower, right, from when we went bearish in quad 4 back in November/December of 2021. That cycle played out. There were obviously ebbs and flows in there in terms of bear market rallies in March and kind of that June to August time frame. And then again, kind of like a little bit sideways there in Q4, but it definitely finished down at the lows, right, to finish the year. And then, we've seen a move higher, and you're spot on. I mean, I hadn't looked on where we finished. So about 7. We'll round it off at like 17% year to date. This is what I will then say after that is that when those lows from December are going to start to roll off. So now all of a sudden, from a 3-month basis, so on a longer term look back, the pricing, things are going to basically, the way that works is that like that look back window is going to shrink. And you're seeing that volatility shrink too, the 20, that 24 or 23 and change on the VIXN right now. And we're also pushing up right at the recent highs of February in terms of the year-to-date standpoint. So this is a critical spot, right? But from the data that we're seeing is that it's going to fail here, or it has the potential to fail here. And so I would be, again, we went to the wood on tech today on XLK. He has not hit the button on QQQ yet. And maybe he's staying away from that given some of the components, right? If you look at the QQQ components, it's got, we're bullish trend on Apple, Meta, and NVIDIA. And those do make up a good chunk of the Qs. And then on top of that, you've got, higher lows and some higher highs being put in across Netflix, Tesla, Google actually put in a lower high, but yeah, so you're seeing some of those components put in higher lows. So that's where, again, it's about kind of the higher probability outcomes to go play. And I'll repeat myself from like the dollar last year. Maybe the Qs aren't, maybe the flight to safety, the cash flowing, the factor exposure that have, good cash flowing companies, dividends, strong balance sheets,
maybe the big boys do hold up, a portion of the Qs, and it's what we've seen recently in terms of this year-to-date move in the Russell, where things with ship balance sheets and poor, basically smaller cap factor exposure, higher short interest. Maybe those are the factor exposures that you really want to be adding to on bounces that are bearish trend. But so that'd be kind of my quick synopsis in terms of the comp Q itself. It was a higher low and a lower high today, so definitely a shrinking range, but that's reflective of VIX, sub 25, or sorry, VIXN sub 25.
Pull back the curtain on the process of a world-class hedge fund on the call at Hedgeye. Join our entire research analyst team live before the market opens for deep dive investing analysis, our favorite stock ideas, and risk manager-in-chief Keith McCullough's macro overlay. Subscribe to the call at Hedgeye weekdays at 7:45 a.m. Eastern. Go to hedgeye.com/thecall for more.
Again, this is where I'll just repeat myself what I just said in terms of on a day over day on the 22nd, the low end of the risk range on the comp Q was 11,005 and the top end was 11,998. Today we're 11,433 and 11,922. So that would be a lower high in the week over week, but a big higher low. So that is good. I mean, this is where, Brian, this is that's the setup you want to see. You want to see the lower high, and that's a front run kind of signal when you're seeing the lower high on both day over day and week over week, which really means the probable outcome is that it pushing higher is the probable outcome becomes lower. So that would be my rundown on the Qs.
So the other piece, I guess, is when Keith talks about the Titanic and everyone running up to that corner before it sinks. That's Apple. That's the other components that people are running to until they can't run to it anymore. Is that fair?
Yeah, yes, I think correct. There comes a point where even those guys have to report reality, and that's where you saw it last. What was it, last Q1 with Google, right? Google and Meta, and you saw similar price action in Apple and Amazon, I believe it was. I'm going off the top of my head, so I should probably pull that up so I'm not misspeaking. But let me just double check that in terms of last. I believe Amazon rallied as well in Q1. What was that, 2022? Shoot. What happened? I don't know what happened here. I know what it is. Sorry, guys. The 2022. Yeah, so Amazon kind of rallied. Yeah, I was right. Yeah, so Amazon sort of rallied in that that March standpoint as well, where it went from bearish trend and then temporarily it got back to bullish trend along with Apple and stuff like that. But my point is that they also have to report reality, right? Amazon just fired more people. Apple came out with I believe that pay later component that was that they
pay
just
never.
Pay never.
Buy now, pay never.
Buy now, exactly. So Brian, it's going to be an interesting component, and this is where I know it's kind of boring, but not boring, but this is where I just stick with the signal in terms of Apple's bullish at the moment, and it's a big piece of the XLK. But you've got Microsoft that's bearish. That's another big piece of the XLK, and the Qs have a bit more. There's a little bit more nuance there, and I'd say like that NVIDIA and Meta both putting in lower highs though, and even Apple putting in a lower high at 161. Those are big tells. So I will answer this with kind of like a bit of let's see what tomorrow's risk range looks like, and then kind of like Fridays, and then what the beginning of next week kind of looks like, because I think that's going to be the real tell, because now we're going to those top end of the risk range is going to move a little bit higher because of the price action, right? When something moves up, 2%, like Apple did today, same with Microsoft, and Amazon was just over 3%. That's going to naturally bring up the top end of the risk range. So what happens is, where does the price action go from here? Do they push it higher into the quarter end, month end? If so, then that's where you have to trust in the process and the data that that Drago and Drake and Steiner and Ritchie and Tex and Keith all put together in terms of the sinkhole analogy, which I love today, in terms of what's happening under the surface is really bad, and therefore setting up the portfolio today and getting what did you do at VIX in 23, 24, 23, 22? If we get to there, or VIX at 19, 18, 17, what'd you do there? And how'd you position your portfolio? And personally, I think, Brian, not investment advice, just to echo that, but, setting up incrementally with some QQQ on the short side, that makes a shit ton of sense.
Thank you. And I'll say that on the Macro Pro Themes Deck presentation today, it looked pretty apocalyptic out into the future. So, good luck to everyone.
It did. But again, I mean, I told this to Keith. I was like, there were also two areas that you can be three areas that you can be very bullish on, and hence the title of like this notebook review. It's gold, China, and duration. I mean, we added TLT, IEF, EDV, GovZ. You got GLD, physical gold, AAU, which always makes me think of like basketball. And so you've got GDX. We've got K-Web's not on there yet, but it's on the short list. EWT, Taiwan is a factor exposure. We've been more keen on the Chinese exposure in regards to the individual names. Keith mentioned this on the call this morning in terms of some of the top 10 names all have factor exposure to China that are winning, like Las Vegas Sands, Win, MGM, that kind of stuff. So those are all so again, there's places to be if you're long only. As much as it's fun to be, fun. I'm using air quotes here, guys. But as much as it's like, that is, there was a lot of very bearish data. There's also a lot of places that you can go get long. Now, at the same time, you want to be conscientious in terms of, how much capital you're putting at risk when there is potential real risk rising, especially from a recession standpoint, and volatility under the surface, perhaps exploding higher. And that kind of thing. So, it's all about a risk management standpoint as well. And right now, personally, I'm in Keith's camp in terms of kind of putting 25-ish% of capital to work while like having, 75% cash kind of on the sidelines at this point. And I'm rounding things off, so forgive me. But.
Appreciate it. You're giddy. We can hear it.
Yeah. I am. I think listen, if you're a bear, this setup is fucking awesome.
I know. That's what I'm saying. Apocalyptic. I said it. Apocalyptic.
If you're bearish, this setup is awesome. And the fact that like quad 4 components are starting to work is even better. So like this is like really fun. If you're not having fun right now, like, whew,
yeah, the fact that
this is fun.
Gold hits $2,000. Gold hits 2,000. You'll be having a lot of fun.
The fact that Netflix is one of the last bastions of bullishness over the past couple of weeks tells you a lot.
Yep. It does. All from what was that? That was hilarious. The data out of Canada. I think Freebird said it makes up like less than 5% of their overall revenues. But anyway.
People are not gonna slice their subscription, cut their subscriptions in half and pay double for Netflix. There's not enough out there. There's not enough quality content out there for people.
No, I'll tell you this though. This is completely anecdotal, but YouTube just sent me a message over the weekend. YouTube TV is what I have, and they're like raising rates by at least $10 to $15, and it's going from like $65, I think, to 75 or 82, something like that. Again, that should probably be better. I briefly read the.
But they're getting the NFL package with that too now.
Oh, is that what it is?
I believe that they have the NFL package next year too. So they're raising rates just to raise rates, but I believe that will factor in for this upcoming year.
Oh, I should probably read that email more closely because I immediately texted my wife and was like, "We're canceling YouTube TV." And so, because again, you don't tune in for this, but. I pay for like Paramount Plus. We pay for HBO Max. It's freaking ridiculous at this point. I cut the cord like 3 years ago, and YouTube TV was like $45 at that point, and it was awesome. And you had Netflix, and then Disney Plus came out, and they give you like a 3-year deal. That was the best deal going. But now everybody's launched their stuff, and Paramount Plus is actually quite good to be for anybody that hasn't checked it out. They actually have some pretty good content on it, and luckily we get Peacock with because we only have Comcast available in our area, but that's actually been pretty good too. And you get the Office. It doesn't. Anyway, we are completely going off topic here. So
it's all cyclical. Hey, could I give a shout out real quick?
Yeah, by all means.
I would not have hopped up here if I knew that Mr. Salem was listening, because that's real pressure. But David, thank you. Like it's been wonderful to listen to you talk on the couple times that you've hopped up on TV with Keith and with Robert. If you ever want to hop up on these spaces, we would love to hear from you, especially in times like now when you're, at the end of a quarter and things have run up, like Brian was just saying, with Q's now essentially 20% off the lows. From an institutional money manager's perspective, what does next week look like? Those are things that we usually dive into around these times. And if ever you want to hop up, we'd love to hear from you.
And I'd just like to echo that I would really be interested in hearing about David's viewpoints on asset allocation. That would be something I really would like to hear. So I put a few tweets out about David over the weekend. So just FYI.
So I'm gonna bring you in a little behind the scenes here. The only two people left in the office, and this does not mean that like everyone at Hedgeye is not still working, but the two guys from Boston are the only two left in the office. David's in the main boardroom working on a whiteboard, ironing out details on his capital allocation product, and I'm here as well in the studio. But the entire Hedgeye team is clearly, obviously, still working. But it's just quite amusing that both the Boston boys are that travel to the Stanford office are here, and we're working on that just in terms of behind the scenes. David has been kind enough to agree to kind of to come onto these spaces and share a lot of those insights with us. If you haven't had a chance to listen to the kind of 20-minute video that we did 2 weeks ago, I'd really encourage you to do that. We sent that out to all Macro Show subscribers, and really is available to, I believe, to all subscribers. And we kind of opened it up to everybody, but it was a great rundown in terms of getting structured for success. David put together about 8 or 10 slides that were absolutely phenomenal. So would really encourage everybody to go take a look at that. He's helping me kind of build out a Hedgeye orientation type kind of mini tutorial. So there's going to be 4 of them total. And it's been a lot of fun working with him. I've learned so much from David as well. And he's been incredibly generous, as you said, Pokey, and Brian with his time. And it's going to be a lot of fun. I think we're just kind of going to let him keep working on kind of the product and like how the formation works out. And then as we get a little closer to launch, we'll kind of have he'll jump onto these spaces and stuff like that. He's often another little inside baseball. He's often he's a huge runner, so he's often running while listening to these, which is why, although I will text him behind the scenes like, "Hey, can you come up?" He'll be like, "You don't want to hear me panting like a dog right now." So he is, but yeah, he's awesome, guys. I've had the pleasure to spend a lot of time with him over the last 6 months or 5 months. It's been very awesome.
Hey, Robert, I got another question for you.
Yeah,
could you tell everyone here, like, and I've never asked you this question before, but since you've been on, came aboard Hedgeye and, you've been talking to a ton of people, tell me, like, can you just explain, like, what is the biggest mistake people make using the Hedgeye process that you've seen?
Good question. It's a combination of sizing and the expression in which and how they're expressing that investment. I think too many people go straight to like options to try to express a view. And with options, you have to get timing like so perfectly correct. And there's just a lot of different nuances and factors there. But then also just sizing in general, not fully understanding the nuances on volatility adjusting the position sizing, and that even ETFs, like the difference between an XLK, like shorting an XLK versus shorting an XLF, for instance, right? Those are big differences. An XLF has lower, typically, maybe not in the last like 2 months, but historically, XLF would have lower vol, and certainly did if you look at the realized vol in kind of even early March or late February. It was down in the like 16 range on XLF. It's now exploded up to the kind of 30s, mid to low 30s on XLF on a realized volatility standpoint. But I say that because
XLK is realized vol has drifted lower at this point in time, is actually down at 25. But at the end of December, sort of December 20th, it was up in the low 40s. So just like that alone, Brian, understanding the difference in terms of like how big from a volatility adjustment standpoint, like you can get a lot bigger if on XLF, either on the long side or short side, because of the realized volatility is traditionally or historically, if you look at, and again, I'm using like a 30-day realized volatility component there, then that I think is a huge component, right? So even though we say kind of 6% max in an ETF, even on the long side, XLK, even in a quad 2 environment, likely kind of should live somewhere in that 4.5 to 5.5 range because of its volatility. Whereas in XLF, you could take all the way to 6, and maybe even take to 6.25 to 6.5 because of it, depending on where that realized vol would be living. I'm talking about max long. And similarly, on the short side, you could cap it at max long, again, an XLF around 3%, versus an XOK probably closer to 2.5.
Appreciate it.
Yeah. A lot of the components, a lot of mistakes come down to timing of a decision, and then the sizing. So like when and where, in terms of what that looks like inside the portfolio, either being a little late to the game. And again, and oftentimes it does depend on where you come into the game, right? Like if you're coming in right now, and let's just say you just signed up for like Macro Pro or something, and you're just coming into the game now, building out a dollar position actually could work favorably for you. But building out a gold position right now, although we have been getting bigger in gold, but like depending, again, I'm just saying, like if you came in if you try to add to your gold position or build a minimum position like last week, you would have been, again, you'd be going against what Keith preaches, which is like paying at the top of the range. But some people do that, and they kind of like don't fully understand those dynamics and just that patience. I've said this a couple of times, Brian, that I've got 15 plus years. Again, that's not a long time, but I've got 15 plus years of kind of living inside of the investment, community, basically being institutional sales or equity research, et cetera. And it took me I didn't put a trade in for 3 months, right? While I learned the Hedgeye process, learned kind of how Keith thinks about things, how he deploys his, kind of getting the mindset and then waiting for the setup and being patient. And at that point, it was kind of a quad 4 environment back in 2020. And I joined in March to put my first trade in. I guess it wasn't 3 months. It was, almost a little over 8 weeks. It was May. But it was gold, and I still fucked it up. I was just like, I got to get gold in the books. And I remember I was like, I held it for long enough that I ended up making money, but because quad 3 like bailed me out. But anyway, all right. So we're pushing like an hour and a half. I see some other faces, other side asset managements out there. I know a lot of folks enjoy hearing his view and that kind of thing. But anything that Tim, Brian, that you would? Oh, Brian, Tim just dropped off. Brian, anything else kind of on your inside of your notebook or anything that you're thinking about right now? I think we've covered a lot.
No, I think we've covered a lot, and I look forward to tomorrow.
Yeah, me too. The other, I know I kind of mentioned it in passing, silver and platinum, but silver definitely, that signal is certainly picking up steam. Putting in a higher low and a higher high today. It was circled in the notebook, so just want to reiterate that piece. And that natty gas continues to break down. So it's I know it was up 7.5% today, but coming into the day, it certainly was putting in a lower low and a lower high. Top in the risk range is all the way up at 2.50, which is nowhere near this 2.18, even after this 8% move. So lower low, lower high on the natty bow. We'll just reiterate that. Tim, are you back?
I'm back. Sorry about that.
Hey man, oh, you're good.
All right, so I do have one more call out. So my background is oil and gas, and I've been putting bids out for projects that people were considering doing this summer, this fall. And on one of the projects, we had bid out to 4 wireline service companies, and unsolicited, 3 of the 4 came back and cut their price almost in half last week. So it's getting with the price falling off a little bit in oil and gas land, especially in gas. that has knock-on effects. So not investment advice, but maybe consider OIH or some of the service companies for at least short evaluation in your process.
Interesting.
So you can not only lose money in oil, there's other ways in the energy space to lose money.
Oh, Tim. Yep. There are so many ways you can lose money in the energy space, especially if you don't know what you're doing or don't have a risk range to help you.
Absolutely.
But yeah, that's interesting. What, are you seeing anything else? Just again, not like anecdotal, but just sort of any other, like, because that's a really interesting call out, actually.
Yeah,
I've been waiting. I've been wanting to short OIH for like so long, but it just started to break down like a week or so ago.
Well, I'll tell you this. I got a bid in from a certain front
2
company
weeks ago.
that I won't call out here.
Yeah.
And their bid was so bad that I immediately went short of their stock.
I love
like
that.
That's not really process driven per se. It's more of, oh my gosh, I don't know who the winner is in the service space, but it's not you. You're out.
That's amazing.
Other call out in the energy space is if you look at the guys in the Permian, anybody that's gassy in the Permian is really going to struggle here, especially if their hedge basis is NYMEX. So for we all trade NYMEX gas futures and that are sitting like right at just under $2, which is crazy. But the guys in West Texas, they're selling at a Waha price. So all the gas in West Texas is priced on Waha, that then has to get piped down to Houston or piped to Oklahoma or piped to wherever it's going to get processed. Waha is at like 6 cents right now.
Wow.
So if you've got a Permian, producer that's your favorite and they're gassy, look out below.
Wow, I didn't realize it was that low.
Yeah, the beatings will continue until morale improves.
Huh.
So,
interesting.
And the Permian's trending gassier in general anyway, as those wells age out. So,
interesting. Sounds like we need to, so if Brian's our muni guy, it seems like you might be our energy guy, Tim, or at least get. So
I can get you started. There's guys that are a lot better than I am, but I can get you started.
I love it. That's awesome. Well, thank you very much. Mitchell, Other Side Asset Management is in the house.
I have my young little one in the car with me. We're coming from Brazilian Jiu-Jitsu class this evening.
Ooh, nice.
So
keep it very on brand, eh? Very on brand.
Yeah. So I do not have my laptop open and in front of me, and I don't know what happened the first 45 minutes of the conversation. Interesting. Something that Tim said that I just want to kind of tag on to. It was something I think small that he said, but I think it was a very big deal, is the rate of change that the U.S. is cutting versus the rate or hiking versus the rate of change that Europe is hiking makes a difference or has made a difference. I understand the dollar is the pillar in Quad 4s. I'm not second guessing that. I'm not saying no. At the same time, it does or can make you range bound in here for a little while until markets kind of catch up. Mm-hmm. It's kind of funny. Everybody always talks about market efficiency and how everything's all built in. And yet miraculously, nobody figured out that, or not nobody, because we talked about it 2 weeks prior to it happening. But, the vast majority of Wall Street didn't see a credit event coming. And banks got hammered in a matter of 3-4 days. Markets aren't as efficient as people think in certain ways. And this goes to, I think, Brian's question, thought/question in terms of, everybody piling into this tech trade. I think I think the data suggests it's a disaster waiting to happen. It does not mean that I am full bore short at my max on everything right now. I'm actually not. I mean, we do have calendar, we do have the calendar to look at. We have month end where everybody's trying to, mark stuff up, albeit to lower highs, right? So I am not there, but I am hyper aware of where we are in terms of month end, and I'm okay doing things incrementally until we see some big opportunities to take some bigger shots. Maybe we see some more implied volatility discounts with things closer to the top end of the range through month end markup, through first couple days of the next month where 401ks are still putting money to work, and before you get some people reporting with I think X2 hit me up behind the scenes today, was the lightest day of volume on the New York Stock Exchange. Am I correct in saying that?
Yeah, we mentioned how it was quite like Pokey the juice box. He mentioned that yeah, we were talking about volume. How it was quite light.
Okay,
I don't have the actual number. I don't have the actual numbers.
Tuesday's trading volume across the New York Stock Exchange and NASDAQ at 9.63 billion shares was the lowest this year, according to Dow Jones market data. So, yeah,
Wow.
You guys are spot on. So I apologize for mentioning it. I missed it. I
No,
apologize.
no. You're good. You're good. It's a really important call out. It's a really important call out.
you're up whatever you're up today on stupidly light volume. And as all of us who follow the process know, the volume accelerates when markets are getting shellacked and hammered. So, you've got people out of the market right now. You're not going to have a lot of people in the market buying things back, but it doesn't mean that you don't have, I love it, passive, in quote, passive funds being active in the market, right?
Mm-hmm,
So, I think the dollar and currency is a big call out, and I think that Tim nailed it when he talked about the rate of change. But I think it's something that it may have gone over it might have flown over some people's heads. That's all. Very important.
Yeah, no, really important, really important. Yeah, very important call out on both fronts. So well done,
Robert. Can I ask my same question to Mitchell?
Yeah,
Mitchell, what is the biggest mistake most Hedgeye subscribers make when they're learning the process?
So, so I don't disagree with what Robert said. Position sizing and how they're expressing it. I'd also say now from looking at some Hedgeye followers stuff, right? Some Hedgeye guys who try to follow have reached out, and I chat with a handful of them, and I'll never say no to a conversation, try to help people, etc. I think the largest mistake is bag holding. I think it's not cutting the losers before they become problematic, because something should be a short in quad 4. They don't follow the signal; they follow the quad, and the signal trumps the quad. So even though they just bought something, or they just shorted something, they don't want to get rid of it when it breaks trend, or they're not following it closely enough as to when it breaks trend. And I think that people really hold on to some things that they should not be holding on to, based upon them not wanting to take a loss. So Keith always says, small loss before it turns into a big loss. Before I even knew what Hedgeye was, I utilized trailing stops as my capital preservation strategies. So I would always know where I was selling something before, the day I bought it, right? So the minute I bought it, based upon the price, I knew where I was selling it. It was much less active in terms of trading around a risk range, but at the same time, I still knew where I was cutting it. People don't cut losers, and I think that's a huge mistake, especially on the short side, because you can lose more on the short side than you can lose on the long side. Well, no, let me rephrase. Well, shorting, it can go up exponentially, right? You can get squeezed on like a GameStop and get crushed versus the long side, where obviously where the downside is, right?
So could an example be when you go through the risk range emails, Apple was bearish, right, for quite some time.
Yep.
And it got down into the 150s, and I think it got below 150. But
It got down into the 120s, I think.
Okay, but people are bearish on it, and all of a sudden the signal changed.
Right.
And we were sitting this morning. I don't know what it closed at. We're sitting at this morning with yesterday's close being 157. So that would be an example of you're fighting the signal, and as soon as Apple flipped bullish, even if you're down, you cut it and you move on to the next item. You don't get wed to it.
Correct. You don't have to I don't know if I don't know how early on you started listening to the spaces, Brian. I think it was pretty early on, but Chris Moyer and Robert used to bust my chops a little bit because I would always say I need a yellow dot rule, or I was always joking because at Hedgeye Live last year, one of my largest mistakes in implementing the Hedgeye process into my own process, which already had a risk management tool wrapped around it, was I would be buying more at the low end of the risk range, but at the same time, the low end of the risk range was getting super close to trend, right? So rather than cutting my position as I was approaching trend, I was getting knee deep into the position, getting towards my max, and 2 days later, it breaks trend, and now I'm sitting with a full position. And I don't want to sell it, right? Because I'm at a full position. So rather than sitting with a minimum position, I'm sitting with a full position, and it just got cut, or it should be getting cut because it broke trend. So in theory, Keith's trend is ultimately a trailing stop, because every day that the stock moves higher, the trailing stop or the trend in theory moves a little bit higher. So trend is very similar to a trailing stop. Keith's are arguably more accurate, right, than what I was using. So the yellow dot rule is, I would joke with Chris and Robert in terms of, I just need to, I need to know where that trend is so I'm not getting bigger and bigger into it. And you can figure out where things are with listening to Keith very intently on the calls. You can also get yourself or keep yourself out of more trouble by not playing in things that Keith's not active in, because Keith's not going to keep you up necessarily on a trend breakdown in something that he's not talking about unless you're in one of the Sector Pro products, right? So you want to play outside the realm, but at the same time, just know you're not going to have all the tools. So I truly believe not cutting your losses, and again, I was using trailing stops, 2015 when I started running discretionary money. That was before I even knew what a Hedgeye was. So, it's just morphing the Hedgeye process into your process, but still risk management is the key. And we still get, Robert and we talk behind the scenes, and we still try to get better every day, right? So this is an ongoing process. This is an ongoing learning, with me usually, with us doing things, night after the market closes, morning, 5:30 a.m., and trying to figure out what to do. But I think if I'm answering your question, it's what Robert said in terms of position sizing, it's how they express it, and it's not cutting losers before they become problematic. And I think that's the biggest.
Thank you.
Start generating alpha with Hedgeye's suite of Sector Pro investing research products. Dive deep into retail, industrials, technology, and everything in between with exclusive access to the sharpest analysts and actionable ideas on Wall Street. Go to hedgeye.com/research for more. That's hedgeye.com/research.
Just to piggyback. Yeah, and just to echo that, I think it's so a good example is going back to your QQQ question, Brian. On March 20th, so about a week and a half ago on the macro show, Keith, I think I might have even asked this question just randomly, but the trade on QQQ was 298. Now that number is going to have shifted a little bit, but it turned kind of bullish
trade on that day, and it's held above that bullish trade, but it's still bearish trend on the comp Q on the Nasdaq. So I think that's, again, it's something to be conscientious about. And even if you didn't have that number in terms of the 298, and really what I will say or take from what Mitchell said is you can. That's why I talk about the higher lows and the lower highs and the lower lows and what have you, right? Like those dynamics, because even in a bullish trending component, you can, for instance, like the dollar this morning it was flat on the bottom and on the low end of the risk range, but a lower high on the top end of the risk range. So again, like, seeing those components or seeing a bullish trend putting in lower lows, that signal is just getting a little bit weaker. So you just got to be a little bit more patient with it to kind of figure out, okay, where is it going to sort of find a bottom, or like where is it going to kind of find its footing here, and then how does the risk range kind of react from there? Now, it doesn't mean that you shouldn't be active or can't make a decision at that point in time, but just understanding, again, that's kind of why I say position sizing, because sizing up in the ones that are putting in higher highs and higher lows, those are the ones where you want to be max, right? You want to be as close to your max as possible in a bullish trading trend, putting in higher highs, higher lows. That's kind of in the right quad. That's like that's a setup that you want to be, max to the tits in, right?
On a long.
On a long.
Yes.
Yeah, sorry, on a long.
On a short,
conversely,
the other way.
Yeah, you want to be bearish trend, lower lows, lower highs. Natty gas is kind of like a perfect example of what that looks like for the last. I'm just using an example because you guys can kind of go look at that in terms of like what you've seen, really almost like year to date on natty gas. It's been freaking miserable. So the year to date, let me just pull that up. Yeah, it's pretty bad. But again, this is where, so that's where I talk about sizing, because if you get the sizing piece of when and where, the signal kind of flows in with that, and the signal is absolutely the most important thing out there. But that can be a much harder thing to coach, Brian. So out of the gate, the sizing and timing aspect, having a little bit more patience, or understanding, that something can go to the top end of the risk range, even in a bullish trend, and then, maybe the next day, 2 weeks later, a month later, it goes to the low end of the risk range, and knowing what to do and how to position your portfolio accordingly is key. So that's where, and I think, and again, like going back, knowing where the trade was a week and a half ago is likely why Keith hasn't gone to the Qs yet. Now, it doesn't mean that he won't, even though it's like bullish trade. It just, he's waiting. I've seen this play out a lot, and so he's waiting. He got that first lower high today, but that's likely not going to last, day over day. But if he gets another couple in the next 3-4 days, you'll likely see. It's possible that he, where he's already gone to the wood on XOK, it's possible he goes to the wood on Qs as well.
Yeah, because also, and that's to tag on that, people get too big too soon in a short, but also at the end of the day, I think people also forget that the risk range is dynamic. So if things are at the top end of the range, depending upon how powerful that move is to or through the range, well, the top end of the range is no longer where it was. So people might size up significantly at what they believed was the morning's top end of the range. So they go whole hog and max up, but they don't realize, they forget the incremental part, right? So maybe I'll buy some incrementally up over where the top end of the range was for the morning, but you don't know where the range is unless Keith told you, right? So you have to understand that range moved. So yeah, maybe I'll go incrementally, but at the same time, I also know that the range moved, and we'll see when it starts to fail, or when, as Robert just noted, when you start to see the lower highs to be a little bit bigger in that position.
Yep. And even with today's closing price on SPX, I mean, the refresh risk range was 40.26 and closed at 40.27.80. And right now, depending on what the price action looks like tomorrow, that would be that's a new, still a lower high inside of the 1 month risk rate, like 1 month price action. That low is, that high is 40.48.43. So we still got about 20 bucks to go. So it'll be, so keep an eye on that. You know, I suspect that they're going to try to ramp it into that, you know, try to get it up to that 1 month high somehow, right? Big head fake. But anyway, we'll see.
The vast majority of people that I chat with who's frustrated with Hedgeye is frustrated with Hedgeye, but they have how to put it politely, they have a challenging time looking at the decisions that they made based upon the process that is the Hedgeye process. The Hedgeye process in and of itself is a simple process. You know, sell at the top end of the range, buy at the bottom end of the range, yada yada. But every day those ranges move, and every day there's a different dynamic to why you should or shouldn't make a certain decision. So it's not as cut and dry as, well, Hedgeye's top of the range was this and it moved higher through it. You know, I got caught in a short squeeze because, right? You know, I mean, we could talk societal issues all day long, but you know, we're in a scenario where most people just want somebody to blame, other than I need to study this and get better at it. And I think that's the reality. You know, Hedgeye's not perfect. They're pretty damn good, though, especially relative to what else is out there, the research, the honesty in the research. You know, I've said this numerous times before, and I'll say it until I'm blue in the face. I've been in the business for 27 years. So, sorry, Robert, 15 doesn't look very long.
No, it doesn't.
You know, 27 years, I can't believe them. It's almost 3 decades. At the same time, I have read everybody from CSFB, you know, DLJ when they were still around, you know, Goldman, Morgan. You know, if you understand why the research departments write what they do, you'll understand that there is almost no one that says what should be said because of the conflicts of interest that are in this business. And if you don't agree with the statement that I just made, DM me, let's have a conversation, let's talk about it, because I could walk you through the conflicts of interest from the seat of somebody from the retail side, the institutional side, the corporate finance side, institutional sales trading, you know, you name it. I've seen it, and I have some pretty good experience in understanding how firms get paid, why they do what they do, and I've watched it firsthand. So when 94% of all recommendations by Wall Street are buy and hold, and a whopping 6% are sells, and you have 40 to 45% of companies out there in the Russell that literally can't, that they're dying zombies, but yet they're buy and holds. I mean, there's a reason, and that's a conflict of interest. And we can talk about it all day long, but not the medium. But once you understand that, and you understand why Hedgeye does what they do, I think you'd have more confidence in the process, and that you're working with honest and trustworthy people.
Yeah, Mitch, let me piggyback on one thing just to share like my why and how I view it. Obviously, I'm a big asset allocator in terms of fixed income, but when Hedgeye made the call at the end of January 22 to sell, I moved my kids' 529 accounts to cash, like all of it. And then in Yahoo Finance, I loaded in the pricing so I could follow whether or not I saved money or I didn't save money. And even today, like, you know, they just updated the mutual funds that they were in. As of today, I saved 13.25%. You know, it was like 18% last week. So with this run up, right, I'm still at basically 2 years of college, because my child is first year of college, so 2 years of college. So, I mean, it's a massive amount, right? And there'll be a time when there's a call of get back in, buy every
Correct.
dip, right?
Yep.
So between that window of get out and between the window of when it comes of get back in, you have a very difficult environment to navigate. And it's hard. I mean, Robert, you said it one day. You said, short selling is fucking hard. Those are your exact words. And you're right, it is. Because that's what we're kind of talking about right now. And, you know, just sticking to the basics of of get out, there's not a single Wall Street firm that makes money telling you to go to a money market account.
That's 100% correct.
So
Yeah.
That's
me,
right.
that's getting to the basic core of the Hedgeye product itself. I mean, you get to get out with just the early look or just ETF Pro, right? And so those calls to that the crash is coming, like that is worth a lot of money. So
Well, think about it.
Cents.
Think about it,
Yeah.
Brian. Think about it this way. Think about if one of the large, big bulge bracket firms said sell and put 20 to 25% in cash, right? If we see volume spike on days, or we see the markets typically sell off hard or collapse when volume ticks up. Think if one firm across the board, what is Schwab has, somewhere along the lines of X trillion under management, something crazy. Maybe not. What did I read the other day? I can't even remember off the top of my head what it was, but it was a stupid amount of money. And think if 25% of normal, ordinary people just started selling. You don't have the bids. It goes back to the conversation that we had before when we talked about bank stocks going bidless. You don't have the bids. And if that's Merrill, then JP Morgan, and then Morgan Stanley, it's just easier for them to say, just hold and sell the mantra, the narrative that you can't time it. Because if they really started to recommend selling, the whole thing kind of unwinds. There aren't enough bids to take care of the sales. So that's why when volume accelerates, markets typically bids fall out. And that's why they've implemented, circuit breakers to the downside, right? When you have, they don't complain when things are going up. They complain when things are going down, right? We see people literally, a week and a half ago, we literally saw grown men cry on TV about interest rates and SIVB. And now you see people bidding up Ripple and Litecoin. I mean, it is so emotional of a business for many people that's what they resort to. They literally cry on TV. Bill Ackman, it's one of the most embarrassing things I've ever seen. Not a grown man crying. I've cried numerous times, and I cried at my brother's funeral. I get it, but seriously, guys, I mean, it goes to what Keith talks about. So few have a process, and those who are trying to learn the process should really get knee deep in the process, as opposed to blaming people as to why they're losing money because they don't necessarily understand the process or do the work. Does that make any sense?
1,000%. Robert, did you see this conversation go in this direction when we started?
I did not, and I was just going to, this is how Hedgeye Nation is amazing, because it's not like I prompted you guys, hey, can you do your best job to shine a positive light on Hedgeye? It's just very organic. No, it's just very organic. Now, this is not organic. This is going to be a shit segue, but Hedgeye Live is in the month. And I posted...
Shameless plug.
Yeah, shameless plug. Hedgeye Live, our premier conference, is in the month. And folks like, Mark Cohodes and Mike Green are going to be there. Mike Taylor, Nancy Davis, Danielle DiMartino Booth. The list is quite long. But yes, if you're interested, it's here in Stamford, in Connecticut. It's going to be an awesome event. It's actually where I met Other Side Asset Management for the first time, Mitchell in person. Even though we've had many conversations on, here on Twitter and online, et cetera, et cetera. So awesome event, great opportunity to kind of come and have these conversations in person. So just want to throw that out there. And then second of all, in terms of writing that is excellent and also comes from a place of a very positive light. Hedgeye has great research, but Mitchell at Other Side Asset Management, he writes a monthly letter, and we actually posted his most recent letter that was for March, right, buddy?
It was my March.
For March,
yeah.
So that went up. So that's actually on our website as well as his website. So by all means, go check that out. It's an absolutely fantastic piece of literature if you want to
get that on a monthly basis. He's got an email component that you can go check out, but I believe the plan is to kind of post that on our site moving forward as well, because we find it's incredibly well written and valuable information, and information that investors need to be conscientious about and have access to. So that partnership, so that's been awesome.
That was a very humbling ask. When the guys reached out to me, extremely humbling. I think the nice part about I hate talking about myself. I do think the nice part about my note relative to Hedgeye is I try to simplify the data. I try to make sure that we understand the data in a context of simple examples, or examples that almost anybody can understand. So if you're more new to it, if you're intermediate to it, it's the data, it's driven by the data, which obviously Hedgeye is, I think, the best data out there in terms of aggregators of, and it allows people to kind of conceptualize. So it's kind of funny when Keith talked about when he released the sinkhole example today, I'm like, I wrote about that in 2018. I mean, like I used the sinkhole analogy, about the surface, everything underneath the surface is cracking, and the surface area is the last to cave in, right? So I didn't even know about Hedgeye in 2018, but when you start to
Past month was about the Lorax and the gray wolf. It was great.
Yeah, I try to bring some stuff in to make the analogies enjoyable for the reader, plus the data. But absolutely. I appreciate Hedgeye including me and people taking a look and reading, and it is a little bit longer than most of the Hedgeye stuff because I'm writing once a month, right? So I'm just allowing my clients and then prospects, or just anybody in general, because it's not behind a paywall, to basically see what's going on month over month, right? And that's what makes it a little bit longer. But yeah, cool.
100%.
Robert, my last comment is what one of the things that I like about Hedgeye that I don't do this, but I will probably when Quad 4 is over, is I get all the call emails, right? And in there it'll give at the top it'll say tickers discussed, and in green is the longs and red's the shorts. You could literally just with the Hedgeye analyst research, do your own little miniature mutual fund. I'll give away one because it's pretty simple, right? Like I'm looking at the email, right? Long McDonald's. Wow, right? McDonald's. So you literally could, if you don't like the macro part of buying ETFs and things, and you really wanted to get more granular, you can do that. And I know a lot of people, in terms of access and asking questions, I actually ask a lot of questions, in particular to Rob Simone on NPW, and do a lot of research on NPW. That's what I like is you can do individual tickers through the research side, and if you're long only, you can just do the long onlys and do individual companies as opposed to an ETF. So I think that's something that a lot of people don't take advantage of on the retail side. Maybe they do on institutional, I'm not aware of, but that's just my 2 cents.
And Robert, before I hop off, one last thought to you as well.
Right.
I tie on to the shameless plug for Hedgeye Live. I thought it was kind of funny because, you and I sat down, and we sat down with Chris in the lobby, and it was just the three of us sitting around shooting the breeze.
Yep.
And before you knew it, we had 15 strangers just talking, right?
Yeah.
Just all talking shop, exchanging. Hey, you're such and such handle. You're and it was a great
reviewing the notebook
place. That's exactly right. So it was basically doing this, but face to face in person. We all had our notebooks out, and we were all talking shop. And you get a bunch of guys who are all gals too. Leslie was there, and you get a bunch of people there who are all trying to just get better and understand the process, learn the process, and get away from the narrative, which is what we all were trained on, right? So it takes a lot of work to get away from the BS. And once you have a better understanding of why we get away from it and what they do, you'll want to learn this. I want to learn this process more and more every day, right? So I do have to
Absolutely.
hop. I have a
No,
a
we're
little
gonna
one.
wrap up. No, I appreciate it. No, it's good way. No, I have enjoy. I don't know if you got gymnastics tonight, but have fun and appreciate your commentary, Brian, Tim, Pokey. It was a good session today. And in terms of the individual stocks, we did put on the pitch on Tuesday morning. That's absolutely free from a webcast standpoint. If you haven't caught that yet, by all means, go check that out. And I've been putting on some Spectre Head spotlights with the team here. So I should say, we've been putting it on. We've been putting it on with the sector head. So Brian, just along those same lines. Been sitting down with guys, as I mentioned last week, was Felix Wang. I sat down with Emily Evans from the health policy standpoint. Tom Tobin, Freebird, Todd Jordan, et cetera, et cetera. I've actually got Daryl Jones tomorrow, which should be a lot of fun. He's the head of equity research and institutional sales. So it will be a bit of a different conversation, but should be a really wonderful one. He's got quite a breadth of history in terms of both working on PE, VC, inside of hedge funds, on the sell side research. He's been kind of all over, let alone also knowing Keith all the way back from their teenage days. So should be a really great conversation. But check those out. Those are all free on the Hedgeye TV YouTube channel. So that we will leave it at that. I thank you again for everyone's participation. And
Thanks, Robert.
Absolutely. Good luck out there. We'll be back this time next week, Wednesday, 4:30. And tomorrow night we got Muni Guy. We're gonna be talking Muni bonds, baby. Get ready.
Amen, brother.
Get your popcorn ready. And since Brian's from Kentucky, maybe a little bourbon or
I like it.
something. Just come one, come all. I'll share the spaces invite here in a few minutes.
Have a good night,
see you,
guys.
bud. Thank you.